Welcome to Pete's Property Podcast, brought to you by Buyers and hosted by Pete Wargent, buyer's agent, finance and real estate expert, and all-round property guru, plus published author. Join Pete for 30 minutes as he chats all things property with a new guest each week. Learn practical tips from the movers and shakers in the property industry and well-known personalities sharing their property journeys.
G'day, welcome to this week's episode of the Pete Wargent Property Pod. I'm thrilled to welcome back on to the show familiar face, Louis Christopher from SQM Research. Louis, great to have you back on.
G'day, Peter. Great to be with you once again and your audience. And no doubt we're going to have a very interesting discussion.
Can I just say before we kick off, you're looking an awesome nick. Every time I see you, you're looking more streamlined. So congrats on winning that battle. That's fantastic.
Oh, no, thank you very much. Noom is the app that seems to have worked for me. So I'm happy to jump up and down about it for anyone because, hey, if this has worked for me, it should be able to work for a lot of people.
100%. And I know my wife was also a fan. So let's just rewind the clock a little bit, Louis. So we spoke last towards the beginning of 2022, and it's been a tumultuous year, to say the least, with the shutdowns and reopenings. Interesting to look back at the time. So the episode was called Run to the Hills, Inflation is Coming. And you were predicting at the time inflation getting near to 10% this year, which at the time sounded like an outrageous prediction. And yet here we are, even the Reserve Bank is forecasting inflation peaking at around 8%, and we're not at the peak yet. And your advice at the time, or your observation, was two things, really. Firstly, get your inflation hedge in. But secondly, be careful with debt because at some point there'll be a hard time. So be a little bit careful with gearing. So here we are today, December 2022. The inflation prediction has come to pass, and also rising interest rates and mortgage rates for people who are geared.
Yeah, it's so interesting. So this time last year, the Ukraine war had not started yet, as we could see through the indicators, and I think you could see it too. You made a few comments on Twitter about it. It seemed pretty apparent that inflation wasn't going to be transitory. It was continually trending up. And we also knew back then at the time what was going on in the rental market, and that it had not yet fed through into the official numbers for CPI, and that would have to eventually feed through. Now, it's taken even longer than expected for it to feed through. To me, it seemed pretty apparent that we were going to get much higher inflation. We must remember on all this that historically, real estate's actually been a very good hedge against a higher inflationary environment, and that only makes sense. I mean, who wants to have a situation where you've got your money in the bank, and sure, it's safe, but you're effectively losing maybe 7-8% in real terms on that money, that cash, because of the elevated CPI, versus something such as real estate that is tangible, that is real, and has rental growth to it, which is kind of hedged against inflation. And this is exactly what we saw in the 1970s. So doing a bit of modelling, I did believe that there would be a bit of a hedge there. There would be a bit of an opportunity and a bit of a nice, a relatively safe space to park your wealth during what could be a very uncertain time. And yes, when we consider 2022, there has been a correction. The correction has not been as significant as what some had feared or spoke of. It's essentially, for most areas, stayed down to single digits. And one must need to actually ask, well, why? I mean, if we were to start the year again and you told me or I told you we were going to have a cash rate of 2.85%, most likely going into the threes, we probably would have predicted a pretty hard landing for the housing market. But it hasn't transpired. And I think when you dig deeper, the reality is that inflation has probably been a bit of a tailwind behind property to stop that type of fall occurring this year. So yeah, I'm still a believer. And as you know, earlier this week we released our forecasts for 2023, and we believe that yes, there will be a recovery, albeit a modest to moderate recovery next year. Once again, on the back of the fact we'll have higher inflation, which in real terms will translate to higher rents, and a peaking in the cash rate.
I remember hearing a Charlie Munger quote years ago, and he said that when he talked about some of his mental models, and he talked about over 100 years, all fiat currencies going to zero. In other words, that's seemingly innocuous inflation, just a few percent a year here or there. Well, if you multiply that out over the years, inflation can really eat away at purchasing power. And I guess that's one of the reasons that real estate has been popular as an inflation hedge, and the debt gets inflated away over time. I guess the thing, as we've seen this year, is that while inflation or real estate might be a good inflation hedge over periods of time, potentially over the short term, not so much. Certainly seen the cryptocurrency narrative about being an inflation hedge. Well, clearly not in the short term. And I guess we've seen a bit this year with real estate prices down, 7% from the peak.
Yes.
Inflation maybe finishing the year around 8%. So I guess in real terms, quite a significant decline. So you talked there about the boom and bust report, which you famously put out every year. And we'll put a link in the show notes for where people can go to get their copy, and also just to have a look at some of those scenarios. So obviously, with everything that's been going on over the last 2 or 3 years, we know things have been quite volatile, and the potential for things changing from month to month and quarter to quarter is very high. But with that in mind, the base case scenario that you've got for next year points to capital city prices rising by around 3 to 7%. But that base case scenario is predicated on the cash rate target not going above 4%, which at the time of speaking looks very likely, but I guess things could change.
Absolutely. And yeah, this year we did a lot of work in terms of at what point is a real breaking point for the market, where you see a lot more forced selling activity in the marketplace. So as you be well aware, yes, there has been a correction in the market. It's been led by the lack of buyers, less so lots of sellers hitting the market. And as you know, we monitor distressed listings, and yes, there's been a tick up, but it's nowhere near levels we had prior to COVID. But yeah, we did a lot of work on at what point would there be a significant forced selling event where many sellers would just hit the market and have to sell. And that involved speaking with a number of non-bank financial sector managers who look after loan books, as well as some banking sector managers who also look after loan books. And so basically the question to them was, at what point do you get concerned about your book in terms of a theoretical average lending rate and what that really means for the cash rate? And the general consensus was roughly around that 4% mark. And no one knows for sure, of course. It could be high threes, it could be early fours, but it seemed to be consensus was about that point. So that was one of the key assumptions that I had across a number of these scenarios. And the thing is too, Pete, is that I think the bank's aware of this as well. They're aware that there is a breaking point for the housing market. I'm not sure whether they've assessed it at around 4%, but they know it's there. And they would surely have the same information I was able to actually get. So I think they're aware of the situation. As you can see, yes, the base case scenario is that we peak somewhere no higher than 4%, ideally a little bit lower than 4%. Inflation peaks at 8%, starts to fall back to perhaps 5% over the year, which you might be aware is the RBA's general base case scenario. I think they had 4 3/4 for the duration of 2023, and that we fundamentally have a soft landing in the economy overall, where unemployment rises to no more than 5%, or stays just below 5%. So in that scenario, you've got relatively strong nominal GDP, which we believe there's a strong relationship between nominal GDP and housing prices. And you have an economy that's still moving forward. We avoid a recession. And under that scenario, yes, we see a recovery in the market. Over and above that, Pete, as you might be aware, we monitor and measure auction clearance rates. It's a series which is generally regarded as being a more conservative series. It's one we don't need to revise. And on our series, clearance rates have actually been picking up in Sydney and Melbourne. And you'll note here the city which we think will actually outperform next year is Sydney, followed by Perth. Now, why Sydney? Well, there's a number of reasons for that. Besides the leading indicators just starting to point north a little, we got to remember that, of course, the international borders are well and truly open, that overseas arrivals are definitely on the up. They're quite high, as you've been actually pointing out yourself. Generally, Sydney and Melbourne is a first port of call when it comes to overseas arrivals, and they will generally rent a property and some may well buy a property. So we've got that occurring. So that means, of course, an expansion in underlying demand for real estate. Next to this, of course, as we're all well aware, there has been a rental crisis. Rental vacancy rates remain extraordinarily tight. They've been actually getting tighter in the capital cities. We're not in a situation here where we've got a shortage of real estate. And I think this is where some of the housing bears have been going a little bit wrong. I think in order to generate a full-scale housing crash, one of the ingredients for that is you need a flood of stock, a flood of properties, and it's generally new properties where there's been overdevelopment over a short space of time. Now, we just simply haven't had that in this country. And so it's one of the missing ingredients. If you're a crash believer for 2023, this fact runs against that thesis. Look, even in a scenario where we see interest rates go above 4%, yes, it would mean another correction, but I don't think it's a full-blooded, Irish type crash, US style type of crash still, because of this issue that there's still not surplus stock out there.
Yeah, that makes sense. When I was about to ask the next question, I was looking through the numbers, and my question was going to be, you've got Sydney there to lead the rebound, and I sort of jotted down a couple of notes as to why that might be the case. I think immigration was one of my sort of points there to ask you about, which you've already covered off. I guess Sydney's had a bigger peak to trough decline than some of the other cities.
Yes.
What do you think about the stamp duty reform in New South Wales? Is that one of the factors that feeds in there? Because
it's a key factor. It's a key factor that the other cities do not have, and one of the main reasons, besides immigration, besides the stronger Sydney local economy, that we've been a little bit more bullish on Sydney this year. So, of course, the property tax change is about encouraging first home buyers in the market to essentially avoid stamp duty altogether, provided they're buying a home under $1.5 million, and opting for a longer-term land tax bill, which would occur each year. And if you do the numbers on the stamp duty versus the land tax, essentially as a first-home buyer, you're ahead of stamp duty for many years. And on top of that, you're essentially, if you take it all the way up to $1.5 million, you're saving close to $100,000 up front. Now, that's a meaningful saving. That combined with the tightness of the rental market will mean that we will see many renters turning themselves into first-home buyers in 2023, provided, of course, they can get a loan. That's a key, and provided they can hold their job and we don't have a hard landing in the economy, I think we will see this movement. And that definitely factored into our forecast for Sydney for 2023.
So one of the other themes I have noticed in your commentary there, Louis, you mentioned there the rising rents, which kind of is impacting the rent versus buy equation. And in some cases, we've seen your asking rents index absolutely surging ahead in Sydney and other cities.
Yes.
Also, construction costs have notably been very, very high. So I guess that to some degree maybe is underpinning the lower end of the housing market. Plus, we've got the stamp duty reform. So are you seeing then potential in 2023 for the unit market to maybe do better than the detached house market? Because we haven't really seen that over the past decade. That affordability gap between houses and units has never been as wide as it has been this year. So you're seeing some potential for the lower end of the market, potentially units leading the rebound?
Units, yes. And so far in this downturn, units have been outperforming houses, as we know. So, yes, I do believe the unit market will outperform. And when I say the unit market, I'm talking about existing units. We're not talking about let's go off and buy an off-the-plan development. This is the existing secondary unit market. And our expectation is that it will outperform on the back of an increase in first-home buyer activity as well as an increase in investor activity. So investors generally have a budget to be able to buy at the middle to lower end of the market. Units often tend to be an interesting asset class for investors as well. And potentially, if we were to see a return of the New South Wales state government, I think we can expect to see a rollout potentially next year of this stamp duty land tax option to all buyers, including investors. That's secondary buyers, of course. I'm pretty convinced we will see an increase in investor activity. Now, keeping in mind, of course, investors are generally momentum operators. They don't generally like to buy when the market's still falling. They certainly like to buy when the market's already rising. So before we'll see an influx in investor activity, you would see first need to see an increase in owner-occupied activity before you see the investors really jump in any big way.
Do you want to save on buyer's agent fees? You could save thousands with Buyers Buyers. As Australia's most extensive network of buyer's agents, we can lock in highly competitive prices. Plus, our national network of buyer's agents are some of the best in the business. So get the Buyers Buyers advantage and talk to us today. Call 1-800-975-051 or visit buyersbuyers.com.au.
Something we touched on just earlier on there, Louise, we have gone through what's been I guess, almost unprecedented couple of years, in many ways more volatile environment than we've been used to. And we've seen a whole range of supply shocks. There's been the Ukraine war that you mentioned. We've had repeat bouts of flooding in Australia, international border closures that have really messed up supply chains. So I'm just looking now to some of your other scenarios. Now, the Goldilocks scenario is interest rates potentially start to fall in the second half of 2023, which actually, just at the day of speaking, US financial markets or futures markets are looking for that, at least over in the US. But then on the other side of the equation, I guess we've seen such volatility in economic data and flows over the last year or two that who really knows whether this is actually the peak in inflation, and maybe something happens, the war accelerates, or there's issues with China. So you also have, there's a Goldilocks scenario where prices rise, say, 5 to 9% in 2023. But there's also a potential recessionary scenario where inflation just sticks around and gets sticky, won't go away. I guess, and in that instance, we've got rising unemployment and sticky inflation that could potentially see declining prices as well.
Yeah, exactly. That's our scenario for what we call a recessionary inflation scenario, where effectively you start having a hard landing in the economy, but the Reserve Bank of Australia is kind of powerless to react because inflation's still picking up. And indeed, they keep lifting the cash rate to above 4%, above this important threshold. So in that scenario, it's a harder landing for the housing market, where you would see substantial price falls, particularly in Brisbane. You would see them in Sydney, -3 to 8%, Melbourne -5 to 9%. Maybe Adelaide could come in flat still. But overall, it's a very, very negative market, and these are price falls over and above what we've already had. So it would lead to a substantial downturn in the housing market. You would definitely see a lot more forced selling activity in that scenario, which would further put downward pressure on prices. That's a fairly negative, darker scenario. It made our top 4 scenarios though. It did, and we can talk about other scenarios we considered too. But the one that I'm actually most concerned about, and we nearly, like if we released a report a few weeks back, we were nearly going to fall on this one, and that's what we call the false dawn scenario. And I'll just explain this one. So this is where the Reserve Bank pauses interest rates, sometime say in the first quarter of next year. And some months later, maybe just a couple of months later, they've realized they've made a grand mistake. And because the economy starts to power ahead on the pause, confidence immediately lifts, everyone goes on a buying binge, and you start to see the CPI rocket up again back towards 10%. And under that scenario, the RBA panics. It realizes that, hang on, we actually have got to run a real positive cash rate to finally get on top of inflation. And so they aggressively lift interest rates in the second half of 2023. And what this means for the housing market is that the pause itself does create a rise in property prices from the pause point for, say, a 6-month period. But then when the RBA realizes their error and they start aggressively lifting interest rates, you start to see a major correction in the housing market, say, towards the fourth quarter of 2023. And hence the reason why I've got these more initially muted numbers. It looks like we're forecasting a flat market, and we are for that type of scenario, but it would mean potentially a major downturn for 2024.
We've had the monthly inflation figures out this week, and they were much softer than markets were expecting. In fact, they were below the bottom end of the market forecast range. So year on year, inflation fell back to under 7%, and some of the forecasters were looking for above 8%. So I guess sitting here today, it doesn't seem likely, but forecasting is notoriously difficult at the moment, and a lot can change quite quickly globally, as we've seen over the past couple of years. And we haven't really got much to refer back to for sort of pandemics in the modern era and some of the challenges related to reopening. Louis, one of the things I wanted to ask you about, we've talked a bit about the macro here, but one of the great benefits of SQM Research's data sets, and if you're not familiar, do check them out at sqmresearch.com.au. So much great free information there on suburbs and regions around the country. The return to the office. So this has been a really stop-start affair. We started off seeing people going back into the office, and then COVID restrictions have been variously reintroduced, and we've had lockdowns on and off in various states, and it's been a very patchy affair. But you're starting to see in some of your information there, for example, we noticed in the Blue Mountains, not only are property listings rising, so properties for sale, but also rental listings are rising quite sharply from more or less zero. Up here on the Sunshine Coast, well, most people seem to be sticking around, but we do know a fair few people are heading back to Melbourne and in some cases to Sydney because they need to be back in the office. Are you seeing some potential risks here to some of the more illiquid regional housing markets? Because, as you pointed out previously, it doesn't take much of a change in the demand to move prices in some of those markets, as we saw on the way up. But I suppose the reverse would also hold true on the way down. And we've certainly seen that in places like Parisian Beach, for example, on the Sunshine Coast. The prices have dropped remarkably in some cases, some huge drops. So are you seeing any other parts of the country where there might be a bit of a return back to the big cities?
Yes, we are definitely starting to see. We've seen it on our North Coast region a little. You've mentioned the Blue Mountains up front. Definitely that is one of the bellwether regions where during the later half of 2020 and well and truly into 2021, there was a huge drop in rental vacancy rates, a huge drop in available rental properties overall. That created a surge in rents. There was also a buying binge in that region as well. And this was, as we believe, a result of people wishing to get away from the inner city locations, which involves meaning getting away from lockdowns, getting away from other people, into areas where they have more privacy. They could get a bigger house. They could get away from the lockdowns. And now, of course, COVID is largely behind us. And we are seeing a situation in the cities where many employers are asking their workforce to come back into the office. Now, some are just asking for 2 to 3 days a week. Some are asking for 5 days a week, and others are sitting on 4 days a week. But nevertheless, there has been that additional requirement. And so that has meant for many people who have chosen this regional living that the realities on the ground is that they must come back. And some want to come back as well. They've tried the tree change. They've actually given it a go, and some love it, and others don't, because among other things, there may not be enough amenities, and they're away from their friends and family. So there has been a move back to the cities. It's the primary reason I believe why we've seen big falls in rental vacancy rates in Sydney and Melbourne, even while some of the regional rental vacancy rates have been on the rise once more.
Yeah, actually, while we're just on that subject, Louis, of rental vacancy rates, this is my final question. Let's take a look at Perth, because this is a question people ask me all the time. What do you think about Perth? Because relatively speaking, over the past decade, since really the peak of the mining boom years, Perth has been very much a relative underperformer, particularly compared to some of the eastern seaboard capital cities, and in fact, a lot of the regions as well. Now, if we rewind the clock to 2016, there was a massive overhang of building from the mining boom. People weren't moving to Western Australia in big numbers as they were sort of pre-2013 or so. And the vacancy rate back then was actually, on your numbers, about 5.5% at the end of 2016, and probably some way through into 2017 as well. As we sit here today, you've got a rental vacancy rate there for Perth of 0.4%, which is almost as low as we've ever seen for a capital city. Maybe Hobart was a bit lower for a time. And just looking at your boom and bust report scenarios, Perth is looking promising, I guess, in almost all scenarios, particularly in the Goldilocks scenario, but even in the base case, 4 to 8%, and potentially even in your third scenario, false dawn, 8 to 12%. So what are you seeing in Perth? It's a question people ask me. I haven't been to Perth for a few years for obvious reasons. So obviously you're fairly optimistic about a strong rebound over there.
Absolutely, we are. Historically, the Perth rental market's led the for sale market. That's one thing we've noticed, and it's obviously a city which can experience significant population flows. So during the good times, when commodity prices are up and there's plenty of jobs, you see an influx of people from other states into Perth looking for that fantastic mining or commodities orientated role. And of course, in the bad times, the reverse is true, as what we experienced between 2014 through to about 2018. So as you've rightly pointed out, right now, we've got a rental vacancy rate of just 0.4%, and we've seen some significant rises in rents or asking rents. So over the past 12 months, we've got on a combined number for Perth, asking rents up 18.8%. Now, when we consider basically prices, so that's actual prices and asking prices, yes, there have been rises. There have been rises. Perth, it's looking like it's going to end up being a little bit up for the year. But given the fact that rents have risen faster than prices, it's meant that rental yields have been on the march higher as well. So your acquisition rental yield has been trending higher for Perth. And at the moment, if you wanted to buy a unit in Perth, you can expect a gross rental yield of nearly 6%, which is quite high indeed. It's a bit lower for houses. It's running at about 4.2%, but relatively speaking to, say, Sydney, these are actually quite good yields. And so what I believe will happen is that we are going to see an increase in investor activity in the Perth market. let's keep in mind too that Perth house prices, look, yes, they're up for the last year, but overall, when you look at, say, the last 15 years, they've hardly done anything. In fact, up until about 3 years ago, the Perth median house price for back in, say, 2019 was actually lower than what it was back in 2007. So in terms of an affordability play and a value play, we're hard-pressed to find any city better than what we're seeing in Perth.
Well, yeah, I can actually see that. I'm just scrolling through not only your scenarios, but all the various indicators you've got on the SQM Research website. And I guess across all of the metrics, it seems to be stacking up very well. I suppose the people tend to be reticent after a period of underperformance, but obviously the outlook for Perth is pretty good. Actually, while we're on that subject, Louis, something that people ask me about a lot is the rental market, because the ABS records some official figures for rental price inflation based on a sample of properties in the existing market. But your asking rents index, which I guess is a leading indicator because it presumably takes some time for asking rents to be reflected in new leases and then eventually existing leases. But as far as I can tell, there's been no let up in the increase in, particularly in the capital cities. Asking rents over the quarter still seem to be rising at around 5% each quarter, 20% per annum. Are you seeing any slowdown there, or is it just powering on? Because you mentioned immigration's picking up rapidly and we're not building as much.
It continues to power on in the capital cities, Pete. It's starting to come off in the regions. And we mentioned the Blue Mountains earlier, and we're actually recording a fall in asking rents in the Blue Mountains now. So, yeah, definitely powering on for the capital cities. Now, there will come a point, and I do believe it's going to happen later next year, where we'll see a peak in the rental market for the capital cities. The housing market, including the rental market, is actually a reasonably efficient market. In other words, everything eventually does get priced in, just like the stock market. It just takes a little bit more time in the housing market. And so I'm expecting this tightness to eventually be fully priced in and for rents to eventually level out. But there's a few other things which are going on next year as well we just need to consider. Firstly, the number of dwellings which are expected to be completed, and I know we've talked about this in the past, the number, according to the ABS, is looking at about 240,000 dwellings for next year. Now, that's up well and truly on this year, which looks like the number's going to come in at roughly around 170,000. I think if the ABS is right on that, we should see additional completions come through. Not that it's going to be a massive amount. I still think the market overall is going to be in shortage, but it's going to be a little bit higher. Second to that is this notion of people grouping together once more to share the burden of the rent. We noted the number of occupiers per dwelling significantly reduced over the COVID period. People didn't want to live with each other anymore. They wanted a bigger property. They wanted to get away from COVID. That's all changed now. And with the higher rents, people are looking to share together a little bit more to share that burden of the rent. So I believe that's occurring. And then, of course, finally, which I think may well be a factor later next year, is that if we do have an economic slowdown, and I mean just a slowdown, not necessarily a hard landing recession, I think there will be a larger number of Airbnb properties moved back over to the long-term leasing market. So as I'm sure you're well aware, if you look at sites such as AirDNA, which measures Airbnb properties, you compare that against our numbers. In Brisbane and in Melbourne right now, there's more short-term leasing properties on the market than what there is long-term leasing properties. Now, surely we must be getting to the point where that short-term leasing market's getting oversupplied. And if we were to have an economic slowdown, then you would see less business travel. You'd probably see less holiday travel as well. And that would affect the Airbnb market, I would have thought. You would see those property owners try the long-term leasing market once again.
Yeah, well, that makes a lot of sense to me. I think I've recounted on a podcast elsewhere. I stayed for a few weeks in Sydney not so long ago. The block I was staying in McMahon's Point, there was maybe 80 units in the block. And I think, 4/5 of them were on Airbnb or short stay leases. And it was fantastic, harbour views, really easy to jump on the ferry into the CBD. But as you said, I mean, how many short stay properties can the market sustain? I'm not really sure where the peak is for that. I tend to agree, Louis, with your point that although housing markets are not perfectly efficient, they do tend to be more efficient than you might think, particularly over periods of time. You've just triggered me to ask you another question. And that's about these 240,000 dwellings that were supposedly under construction at 30th of June. So I spent, over recent months, I've spent quite a lot of time in Melbourne, a few weeks down there, a few weeks in Sydney, Brisbane, Sunshine Coast. We actually even travelled up the East Coast. And I can't see anywhere where these 240,000 dwellings might be. And I know there is sort of data at the state level and so on. Am I missing something here? I just can't visualize, because when we went back to, say, 2015, 2016, it was really obvious. There were dwellings everywhere. You went to a suburb like West End or Newstead or Fortitude Valley in Brisbane, those units going up as, all over the place, cranes you could see on the skyline. But this time around, I don't see it. And I do sort of get the impression that a lot of it was driven by the home builder stimulus. So you'd expect it to be sort of detached homes spread all around the country, which kind of makes sense. But is there a possibility that these numbers are overstated somehow? Or is it, potentially dwellings that have been commenced and not completed?
It's possible. I mean, the thing is that once you commence construction, and as you know, they have a measure of commencements, I mean, you're fully committed as a builder. You've got a contract in place. You've got a buyer there. Very few buildings are built on spec these days. The expectation is that the dwellings will be completed, but I don't disagree with you. I mean, I'm lucky here to have a good outlook for for Sydney here in terms of the inner city, and there isn't too many cranes out there right now. That's for sure. Yeah, I agree. It's an interesting one. I don't know what the answer is. I guess for now, as an analyst, I have to trust the ABS data, though at times, of course, I have doubts. And you touched on their rental series, and yes, I have doubts on their rental series too. But it's an interesting one. If it does transpire, I think it will help, though, alleviate some of the pain out there that renters are clearly having. And as mentioned, I think overall the expectation is the market will price in this tightness, and we will see some relief, and eventually these pretty aggressive increases in asking rents will eventually peak.
Yeah, I mean, I guess we'll find out soon enough that there's 100,000 detached homes under construction at the end of the financial year. Well, as you know, you can bang up a house in 4 or 5 months these days, so we should be seeing that supply landing around about now. So I guess all will become clear in due course. Louis, if somebody wants to get a copy of your very affordable boom and bust report, which is, I guess, always one of the most followed reports in the media and around the country, where should they go to grab their copy?
Oh, they just need to come to the front page of the SQM Research website. So that's sqmresearch.com.au, and they'll see a link there to the boom bust report. And in the report, look, we've spoken at the capital city level today, but in the report, we get right down to the postcode level in terms of data. So we provide data on every postcode. We provide the ratings to those postcodes. So it's like a quantifiable risk assessment that we do there. Just some essential data on that postcode in terms of how it's been performing on the rental market, on yields, on actual prices. I've been doing this report now since 2011. This year it's a pretty big report. I think it goes up to 150 pages. We're including all the postcode information. I think I might be getting close to my last report, Pete, on this thing. It's quite a mission to put together, and I've got a lot of fans on Twitter, especially my housing bear fans, who I love it when I come out and talk about the market going up.
Yeah, well, you did say this week you're bound to cop a bit of flack, particularly because most of your scenarios there actually see prices rising in 2023, which a lot of people listening to this podcast will be pleased to hear about, but there's always two sides to every equation. Louis, thank you so much for coming on. I strongly recommend you getting a copy of the Christopher's Housing Boom and Bust Report 2023, anybody who's tuning in. And Louis, let's catch up again sometime next year, and we'll see which of these 4 scenarios is playing out.
Thanks, Pete. Would be more than happy to do that.
Pleasure. Thanks, Louis.
Thanks for listening to Pete's Property Podcast, powered by Buyers. Don't forget to subscribe and join us next time as Pete chats all things property with a new guest. And just a reminder that the information provided in this podcast is general advice only and doesn't take into account your personal financial situation or needs. You should always consult a licensed professional to discuss your individual personal circumstances.